Welcome to Trading Intelligence LLC. Tax Planning Strategies. This video introduces more than 10 year-end wealth moves that will help you maximize your tax return in the upcoming tax filing season. As we get close to the end of the year, the clock is ticking for taxpayers who want to minimize what they will pay next spring. Tax moves should be made within the context of the overall long-term financial and investment plan. Therefore, it is critical to make sure to check in with financial and tax advisors. This video outlines 10 year-end tax planning opportunities now available to minimize individual tax obligations. Number 1. Long-term capital gains. Short-term capital gains will be treated as ordinary income. Long-term capital gains will have more tax benefits. In 2021, individual filers won't pay any long-term capital gains tax if their total taxable income is $40,400 or less. The rate jumps to 15% on long-term capital gains if their income is $40,401 to $445,850. Above that income level, the rate climbs to 20%. Here are tax planning opportunities. A. Consider holding capital assets for at least 12 months, as short-term capital gains are taxed at ordinary income rates. B. Consider gifting appreciated stock or mutual fund shares to relatives in a lower income tax bracket, such as children or grandchildren, who may pay less or no tax on the long-term capital gains when the shares are sold. Number 2. Tax loss harvesting. If you own stocks that have lost money, you can sell them and deduct up to $3,000 on your federal taxes. That money can offset gains on other stocks or be applied to regular income taxes. If you are facing an unusually high income year or had tremendous losses, this might be a good strategy. Just be careful not to violate the wash sale rule, which would disallow the deduction. This rule states you cannot purchase the same or a substantially similar stock within 30 days before or after the sale. Number 3. Maximize 401k and IRA contributions. If you are an employee and your company offers a 401k plan, you should try to maximize your contribution to boost your retirement savings and reduce current year taxes. The maximum contribution to a 401k plan increased to $19,500 in 2021. Employees age 50 or older can also make an additional catch-up contribution of up to $6,500. For 2021, the total contributions you make each year to all of your traditional IRAs and Roth IRAs can't be more than $6,000, $7,000 if you're age 50 or older. If your modified AJI limit less than $198,000 for married filing jointly or less than $125,000 for single or head of household, you can contribute up to $6,000 to Roth IRA. If your modified AJI limit less than $105,000 for married filing jointly or less than $66,000 for single or head of household, you can contribute up to $6,000 to traditional IRA. People can make tax-deductible contributions to IRA up to April 15th of next year. If you are in low tax rate bracket, consider convert traditional IRA to Roth IRA. Number 4. HSA and FSA contributions. Taxpayers with a qualified high-deductible family health insurance plan can deduct up to $7,200 in contributions to a health savings account in 2021. Individuals with self-only coverage can deduct $3,600. Those age 55 or older are eligible for an additional $1,000 catch-up contribution. People can make tax-deductible contributions to health savings accounts up to April 15th of next year. There is no use it or lose it provision with HSAs, as you can carry over unused balances from year to year. Amounts contributed to a healthcare flexible spending account, FSA, are not subject to federal income, Social Security or Medicare taxes. For 2021, the maximum contribution is limited to $2,750. The maximum carryover amount for 2021 is $550. Historically, the use it or lose it provision applied to amounts contributed to a flexible spending account. Number 5. Contribution to a 529 plan. Families with children can use 529 plans to prepare for college expenses and save on their state income taxes next spring. Most states offer a state income tax deduction for contributions made by residents to a state-sponsored plan. However, a handful of states may allow a deduction for contributions to any 529 plan. While there is no federal tax deduction for 529 contributions, money in these plans grows tax-free and can be withdrawn tax-free when used for qualified education expenses. Number 6. Charitable donations. Year-end is a great time to make donations to qualified charities. The qualified charitable distribution is a valuable gifting strategy if you want to give to charity in a tax-efficient manner. With a $12,550 standard deduction for single filers, $25,100 for couples filing together, in 2021, it's tougher to itemize and claim the write-off. The above-the-line deduction for cash contributions to charities that each taxpayer can claim is now up to $300, so taxpayers who do not itemize can take advantage of this new deduction. Donate appreciated stock to charity to avoid paying capital gains tax and get a fair market value deduction for stocks held for more than 1 year. Sell depreciated stock and donate the cash proceeds to charity. You will receive a charitable deduction as well as a capital loss benefit on the sale of stock. Capital losses offset capital gains, and any resulting net loss in future years offsets a maximum of $3,000 in ordinary income for a married filing joint taxpayer, $1,500 for all other taxpayers. If you are a sole proprietorship and business owner, consider the following strategies to minimize taxes. Number 1. Defer income. If your business uses the cash method of accounting, you can defer billing and collections for products or services until year-end. If you use the accrual method, you can delay shipping products or delivering services. Number 2. Accelerate expenses. If you are a cash basis taxpayer, consider accelerating expenses by paying for business expenses by year-end. Credit card payments are deductible in the year charged rather than paid. Number 3. Acquire assets. Acquiring business assets may be a good tax planning strategy, depending on your business situation. For assets with a useful life of more than 1 year, you generally must depreciate the cost over a period of years, depending on asset type. Number 4. Employ your child. If you are self-employed, consider employing your child to work in the family business. The child will be taxed at their rate on earnings. Earnings are not subject to the kiddie tax. Wages paid by sole proprietors to children aged 17 or younger are exempt from Social Security, Medicare, and federal unemployment taxes. Make sure wages paid are reasonable given the child's age and work skills. Thank you so much for watching. If you like this video, please like and subscribe to our channel.